Good morning, everyone. My name is Don Daniel, founder of P.I.L.L Method International, a better way to eliminate debt. And we have been doing this, teaching people how to read an amortization schedule for over 18 years, helping them to understand that they don't have to pay all this interest to the bank. What's going on behind the scenes? Truth and transparency. Truth and transparency, ladies and gentlemen. What is going on with these mortgages, student loans, credit cards? What is it that we don't know that we should have known forever? Miss Latoya, thank you for coming to the stage this morning. What can we do for you this morning?
I am just here to listen and get some information. I'm not yet a first-time home buyer, and so the topic was raised my antennas basically.
All right, well, that's good because we're going to be talking about on our last show, which was Wednesday. There were three topics that people wanted to talk about. Guess what they want? They wanted to talk about down payments. They wanted to talk about how to qualify for a $700K mortgage, and it says, "What if you're not in a mortgage yet? What should you be doing?" So you're here at the perfect time.
Right.
All right. So listen.
Awesome.
So if you have a question, be sure to jump right in. Why don't you go ahead and mute your mic for now, but jump right in whenever you have a question. Okay, Mr. Toya, thank you so much for being here this morning. All right, we're going to add you back as a friend there. All right, ladies and gentlemen, don't let Latoya be up here all by herself. Come up to the stage. And even if you're here in Clubhouse, even if you're you don't want to say much, come up to the stage anyway. You help to populate the room by doing that. If you want to listen, yes, there you go. Come on up. Come on up. And Miss Brooklyn, I appreciate you for coming up. And Miss Brooklyn, did you just want to populate the stage, or did you have a question or a comment this morning? I think she just wanted to populate the stage, which is just fine. All right. Anybody else? Like Miss Brooklyn, just want to come up and populate the stage? Come on up. Raise your hand. Look, you want to learn from the stage. Don't learn from the audience. You know, I don't know if this is true or not, but when I was in church, I wanted to get up front because for some reason, I thought that being up front, I would get the information better and faster. Probably not true. Probably not true. But anyway, why don't you come on up front? Come on up front so you can get the information better and faster if you are up front on the stage and getting your information from here. So today, folks, we're going to talk about a $700,000 mortgage. We're going to talk about down payments, different ways to look at a down payment. And what if you are not yet a homeowner? And what we're going to do, Ms. Latoya, in honor of you, we're going to start there first. We're going to start there first. So if I need you guys to take a look at the chat. If you look at the chat, that there is a link to my YouTube channel there. All right, a link to my YouTube channel. We're going to be putting some things on the screen so that you'll be able to see this. So, Ms. Latoya, if you have another phone or a laptop or what do you call those things? A tablet, okay? A tablet that you can look at. You can listen to us on Clubhouse, but watch what we're doing on YouTube. There is the link in the chat. I'm also going to pin my, let me see here. I'm also going to pin my link to the top of the room. All right. So we're going to put ICE 10K, ICE, which stands for Interest Cancellation Expert, the number 10, the letter K.com. All right. Let's see. We're going to put that at the top of the page. There we go. And we got folks coming in on YouTube. We got folks coming in on watching us on Facebook, Twitter, and LinkedIn this morning talking, and they want to all know what about these mortgages, all right, and prepayments. But Ms. Latoya, let's talk about what we need to understand first when it comes to getting a mortgage. Okay. So first of all, if you're taking notes, don't ever disqualify yourself. If you're a first time home buyer, Never disqualify yourself. All right. The first thing you want to do is talk to a lender. All right. And generally you want to talk to a lender that's local. Not don't go online and put your stuff out there for some of these, for these big online places. Go to your credit union or your bank. Sit down with somebody that you are familiar with, and that may be familiar with you. All right, so they know you, or at least you are a customer of theirs. All right. So now, what you want to do next is get pre-approved for your loan. And says, well, I know my credit bad. Don't worry about that. Don't worry about that. Here's what you want to do. Go get pre-approved. And if there's something on your credit report that needs to be repaired, you're going to do it in the right way. So get with your bank, find out if you can get pre-approved. And if you can, great. Find out how much you can qualify for. If there might be some hiccups in your credit, or your debt to income ratio that needs to be fixed, they can give you a track to run on. If there's something that needs to be fixed, don't try to fix it yourself. I will repeat that. Don't try to fix it yourself. Get with someone who can help you to improve your credit. Listen to me now. Improve your credit profile, not just your credit score. Your credit profile is how healthy your credit situation is. Your credit score just gives you an idea of what your ability to pay. Okay, so that credit score gives you an indication on how well you've paid in the past. Okay, but it has nothing to do with how healthy your credit situation actually is. Let me give you an example. So when you're out trying to get credit, did you realize that you can have a 750, a 775, an 800 credit score and still get denied credit? Did you guys realize that? I learned that. I learned that from some of the credit experts here, like Flame Newton and Los Callahan. Okay, so and if you want to understand what credit profile is like, it says what types of credit do you have in your profile? Okay, credit cards, car loan, a mortgage of some type, personal loans. What makes up your credit profile is so very important. And the length of time you've had credit is important. What types of credit cards do you have in your credit profile is important. Okay, so those types of things. Now, if you don't know somebody that can help you to Mr. Toya, if you, I need you to keep my my digital card handy. Go to ice10k.com on your phone, click that link, and then save my information. If you don't know someone that can help you to improve your credit profile, contact me. I will put you in touch with somebody that I believe is reputable, okay, that can help you to improve your credit profile. But so if you can get qualified, then find out how much you can get qualified for, and then find a good realtor. Find a good realtor to work with you, because a realtor won't work with you unless you're pre-qualified. So here's the thing. If you are not qualified right now, then you must know exactly what you have to do to get qualified. Don't try this on your own. Get somebody to help you. Get somebody to help. Okay? There's nothing wrong with that. Get somebody to help you so that you can be in the best position possible to get your loan. Now, once you understand that, right? Now that you've got your loan, you want to understand how loans actually work. So I'm going to put something on the screen right now so that you can have an idea of what are the most important things you need to know about loans. All right, is how to pay it back. how to pay that loan back. Okay. It's not just getting the loan, it's how to pay it back and how to understand it. And one of the things that we want to, let me put this on the screen for you. All right. Okay, I got to move some stuff around on my screen so I can continue to see here. All right. There we go. We got that going. And we're going to put this in, get this out of here. Boom. All right. Come on. Let me see here. There we go. All right. All right. I'm going to put something on the screen, ladies and gentlemen, so that you can see what we're talking about. And there it is. Boom. And we're going to share that screen now. Here's what you need to see. All right. Here's what you need to see. It is the borrower's right to prepay. That's one of the first things you need to understand about the loans is what does it mean to pay the thing back? All right. So I've got to change some other stuff here. All right. And I have to have the right frame. Okay. There we go. There's the right frame. All right, good. So I need to read this to you, Miss Latoya. All right. If you can't see it, it says, and if you are in here in Clubhouse and you want to see this on the screen, please go to YouTube. I have the link in the chat. All right. I have the right. Okay. Listen to this now. I have the right to make payments of principal at any time before they are due. Oh my goodness. This is going to be part of your mortgage. It's in there, but most people don't know how to read it or understand it. If you are a first-time home buyer, you need to understand how the doggone thing works. So let me ask you, Ms. Latoya, are you still here? Are you still available? Can I ask you a question? Oh, maybe she's busy. All right. But here's what I wanted to ask. I'll ask this of everybody, and you can put your answer. Elizabeth, how are you doing? I've been trying to call you. Good to see you this morning. All right. All right. So let me invite you to the stage as well. All right. You don't have to say anything. You can just sit there. All right. But I invite you up anyway. So, ladies and gentlemen, keep this in mind. And put it in the chat. Have you ever had a class on how loans actually work and how you can make them work for you? Have you ever had a class on how amortization of loans actually works and how you can make it work for you? Yes or no? Put it in the chat this morning. Okay. Okay. Q-Belt says no. Anybody else? If you're online, go ahead. Put your answer in the comment section. Have you ever had a class on this? Okay. So here's the thing, folks. We're expected to use credit cards, car loans. Mr. West says no. Brooklyn Style says no, only until you broke it down. Thank you, Brooklyn. I appreciate you. All right. Let's see here. Credit cards, car loans, student loans, mortgages, all types of loans are set up a certain way. They're called amortized loans. Okay. An amortized loan only means that they give you certain payments to pay over a certain amount of time to pay back the money you borrowed. But the amortization schedule keeps the payment even. It keeps the payment the same each month. So it's a payment you can afford, but it's really expensive. And we're going to get into that in just a few minutes. Husan Thompson says, peace to the room. You are the only teacher I've had. Appreciate you. Thank you, Husan. I appreciate you, man. Thank you for being here. Why don't you come to the stage, man? Listen, come up to the stage, and you don't have to say anything. Just come up to the stage. All right, just raise your hand. Bring you up. All right, and then you can sit there, and everybody that's a friend of yours, all 323, they will know that you're here. All right, I appreciate you, man, for saying that. All right, so we've got some folks that don't know how this all works. So let's continue on with how this is in your mortgage statement right here, all your mortgage papers. I have the right to make payments of principal at any time before they are due. A payment of principal only is known as a prepayment. Okay. So principal only payments means when there is a time in which you can give the bank back money and you don't have to pay interest at that time. All right. Because it's interest that keeps you in debt forever. Do you guys understand that? It's interest that is the real problem here. Listen, if you borrow $200,000 and the bank wants you to pay back $230,000 in interest on a $200,000 loan, what kind of mess is that? Okay, that's over 115%, but they get to call it 6%. They get to call it 6%, but it's really 115%. 115%. And they want to get all that money. So we want to understand what they're doing. Yeah, it's a payment I can afford, but you're getting way too much of my money. I don't want to buy a house for the bank and a house for me. So understanding a payment of principal only is known as a prepayment. Understanding that is important because you want to be able to give the bank principal only payments with no interest. How about that? Okay. Is that good enough? Is that good today? All right. Let's go to the next paragraph, Ms. Latoya. The next paragraph says, when I make a prepayment, I will tell the note holder in writing that I am doing so. Now, that could mean several different things when it comes to the bank you're working with, the bank or mortgage company you're working with. Okay. Giving them notice in writing may be as simple as going to their website and it says on their website, here's where you put principal only payments. That's notifying them in writing. You can put a principal only payment there and then send it in. It's that simple. All right. It doesn't necessarily mean you have to write them a check and then put it in the memo and send them a note. It doesn't necessarily mean that. What it means is, how does your bank want to be notified of the prepayment you want to make? Okay. How does your bank want to be notified? Your bank, your credit union, or your mortgage company? How do they want to be notified that you're making a prepayment? Do it that way, because not all banks do it the same. All right. Find out how your bank wants it and then do it that way. Okay. So the next thing you want to understand is, I may make a full prepayment. What is that? What does that mean to you? A full prepayment. A full prepayment. You can pay off the entire loan right now. Okay. That's a full prepayment. It's money before it was due, because see, let's say your mortgage is due on the 1st of the month. And you come into some money and you want to pay off, you want to pay off the entire loan. All right. You pay off the entire loan but you paid it before it was due. That's a prepayment and you can pay off the entire loan. Or you could do partial prepayments without paying any prepayment charge. Partial prepayments means anything less than the full prepayment, anything less than paying off the entire loan, whether it's a penny, whether it's 10 cents, whether it's $1, whether it's $500, whether it's $1,000, it doesn't matter. If you give the bank money before it's due, if it's less than the whole amount, it's called a partial prepayment. All right. Now, I'm going to stop right here. Here's what it means by partial. Here's what we don't know about partial prepayments. When you make a prepayment, what does it actually do for you? What does it do for you? How much interest did you save when you prepaid? Oh my goodness. Does anybody like discount shopping in here? When you go, who likes to shop on the sale rack? Okay. Put a number one in the chat if you like to if you like to shop for bargains. Put a number one in the chat if you go to the sale rack. All right. Okay. We know. Listen. When we go and we shop for bargains, we love that. Listen. Look at all the number ones coming in. Look at the number ones coming in. All right. So here's my next question. When you buy something at that store and you buy all those things on sale, all right, and you're checking out and they give you a receipt, what's printed on the bottom of the receipt? Do they put in there how much you saved? Yes or no? Do they put on the bottom of the receipt how much you saved? Put a yes or a no in there. Okay. Do you see that? Yes or no? Put it in the chat for me. Okay. Now, here's why they do that. They want to encourage you. They want to encourage you to come back to their store and say, this is how much money you can save by shopping with us. So when you put extra money on your student loan, okay, I'm going to make a prepayment on my student loan. I'm going to make a prepayment on my mortgage, on my credit cards. So that means more than the minimum payment. Okay, so you put more on the minimum than the minimum payment. And when you do that, you're expecting to pay the loan off faster and then also pay less interest. Is that correct? So if you pay extra, if you pay a prepayment, you want to know how much interest did I just save and how much time did I just knock off? Now, I need an answer from you on this one. Many of you, most of you, if not all of you, have paid on a loan more than what was required that month. Have you ever gotten a receipt or a thank you note or a card or anything from the bank or credit union saying, thank you very much for this prepayment. Here's how much interest you saved. Yes or no? Put it in the chat. Have you ever received that? Husan says never. Never. Listen, Renee Wilson Powell says no. Brooklyn Style says no. Come on, ladies and gentlemen. What's going on here? If your department store can tell you how much you saved, why can't your bank, your credit union, your mortgage company, or why don't they tell you how much money you saved with this prepayment? Because you know you saved something, correct? This is why I had to stop right here after the second paragraph. All right. Yeah, it's okay to prepay. It's okay to prepay, but what it's not okay to do is not know what you get for your money. You should always, always, always know what you're getting when you pay your money. Now, here's how you cannot know. Don't call the bank and ask the person that answers the phone, how much did I just save by this prepayment? Don't do that. You know why? Because they can't tell you. They don't know how to tell you. There's nothing in their systems that they can go and hit a button that says, oh, Marcia made a prepayment. Robert made a prepayment. And here's how much interest they saved. That is not in their systems at all. Don't even bother to ask because they don't know. You know who else doesn't know? Your accountant. Don't go to your accountant or your CPA and say, listen, I just put $500 on my mortgage. And here's my mortgage information. How much interest did I save? You know what? They can't tell you either because they weren't taught in their classes. What? An accountant and a CPA? You think they would know how money works? No. And guess the person that sold you your home, your realtor? Yeah, don't call them either. Don't call your realtor and ask, I just put $500 on my mortgage. How much interest did I save? Do you know what? To become a realtor, you do not have to know how a mortgage works. They're not tested on that. It's not part of their education or training. And worst of all, don't call your mortgage company. Don't call your mortgage company. Don't call the person that sold you the mortgage, because to become a licensed mortgage originator, I mean, this is your business. All right. Mortgage originators are not taught how a mortgage actually works. So calling your mortgage originator, the one who actually sold you the loan, to get this information, it's not there. And there may be some mortgage, or if you're in the mortgage industry, put something in the chat. All right. Put a fire emoji in the chat if you're in the mortgage industry at all. All right. Put something in the chat that says I'm in the mortgage industry, a yes or something. Give me something, and tell the people if I'm telling the truth. You're in the mortgage business, but you were not taught how a mortgage works. How about that? All right. AM Millionaire says yes. She's watching us on YouTube. Okay. AM Millionaire says yes, watching us on YouTube. There you are. Okay. So, ladies and gentlemen, what's going on here with these loans, and we're not taught how the loan actually works. Okay. We got Dominic. I'm sorry, sir. I can't pronounce your last name, but it looks French. Okay. Dominic says, gives fire emojis. All right. So what we're talking about, folks, is these are things we don't get, we don't understand, but we need to know. We should know. All right. So now let's go into the third paragraph, because the third paragraph is the most important. If you're new to the room, go to YouTube and watch this. And we're going to, I'm going to copy and paste the link again, so it's going to be easier to find. Here is the link to the live YouTube presentation right now. That's it. Okay. You have it in Clubhouse. Listen to this. The note holder. Oh my goodness. This is so powerful. I can hardly sit still. You really need to tune into this part. The note holder will use all of my prepayments, all of the prepayments, to reduce the amount of principal that I owe under this note. Listen, that is the most powerful thing here, right here. That first sentence in the third paragraph. The note holder will use all of my prepayments to reduce the amount of principal that I owe under this note, meaning this money that I'm giving you, I want it to go to the money that I borrowed. None of it, zero, not even a penny of this money can go to interest. What do you say about that? Not even a penny of this money goes to interest. I want to read this one more time. The note holder, your banker, your credit union, your mortgage company, whatever, the note holder will use all of my prepayments to reduce the amount of principal. That means the money that you borrowed, they will use that to put on the money that you borrowed under this note, and not a dime of it goes to interest. That is key to this whole business. Okay, when you're borrowing money. Okay, so what I'm trying to tell you, Miss Latoya, is it's not just getting the right loan. All right, and once you're in that position, you call the P.I.L.L method. All right, and we will help you to, once you get pre-approved, then we will help you to get the right loan configuration for you, so that when we start to implement the things here that are actually the rules of the game are right here. Okay. The rules of the game are right here. The borrower's right to prepay. How do you pay back the loan? I want to pay back this loan with as little interest as possible. And I still want to be able to live a great life while I'm doing it. I just don't want to give the bank 100% interest on this loan and let them call it 6 or 7%. I just don't want to do it. Do you? Okay, so now the note holder will use all of my prepayments to reduce the amount of principal that I owe under this note. If I make a partial prepayment, there will be no changes in the due date or in the amount of my monthly payment. Now, I'm going to stop right there. You can't get ahead on a mortgage. You can't pay it ahead. I don't care what you've heard in the past. I don't care what you believe. You can't pay ahead on a mortgage. By contract, you owe a payment every single month. Now, if it's a 360 month mortgage, if it's a 360 month mortgage, I need you to listen to me carefully. You need to make a payment every single month. But even if it's a 360 month mortgage, you don't have to make 360 monthly payments. What? Don, you just said by contract, I have to pay every single month. And the contract says this is a 360 month mortgage or 30 years. Yes, you have to make a payment every month, but you don't have to make 360 monthly payments. Every time you prepay, you knock off time as well. You can knock off the number of payments as well. P.I.L.L method clients, I need you to check this out now. If you have a mortgage, you need to click on that link above and get a savings and earnings report. You can get that for free. Get a savings and earnings report. Go to ice10k.com, the link at the top, and you can get a savings and earnings report for free. And know the month, day, and year you could be debt free. Okay, by using your current budget. You're using your current budget by doing this. So understanding that, okay, if I make a partial prepayment, there'll be no changes in the due date. So the payment date doesn't change. The amount that the amount that I pay doesn't change. Okay, and I must make a payment every single month. But guess what? P.I.L.L method clients don't pay 360 payments. They pay around 90. From 360 down to 90, or 87, or 88, or 95. But it's not 360. It all depends on your financial background and your makeup on how many payments you will actually make to this mortgage. But you don't have to make 360 payments. That's the way it's set up. And that's what we're taught to do, but we don't have to do it that way. Okay. If I make a partial prepayment, there will be no changes in the due date or in the amount of my monthly payment unless the note holder agrees in writing to those changes. And that usually means they're going to recast the loan. Don't let them recast your loan. Don't let them change, because listen, when you start making these prepayments and they start calling you, well, let us recast the loan for you. All right. Because they know that prepayment that you just made knocked off 15 payments that they'll never receive, or 10 payments that they'll never receive, or 5 payments that they'll never receive. Okay. And they want to recast the loan for you, saying, all right, if you knocked off 5 months, well, now let's recast it and give you not a 360 month mortgage. Let's recast it and give you a 355 month mortgage. No, don't let them do that. They're trying to recover some of the interest that you just saved. Don't do it. When a bank offers you a deal, all you have to do is repeat this. Repeat this to yourself. All right. Are you ready? Repeat this to yourself. If I'm saving money by doing what the bank is suggesting, who has to be losing money? Just say that to yourself. Anytime a bank offers you something, just say that to yourself, and then you'll look at it in the right light. If I'm saving money by doing what they're suggesting, who has to be losing it? And if your answer is the bank has to be losing it, then you need to really watch out. The more money that you believe you're saving is more dangerous for you. The more money that you believe you're saving is really dangerous, because they're getting ready to make a ton. If you want to know, if a bank offers you something and you want to know how to read it correctly, go to ice10k.com and contact us. I'll even give you our business number. Okay. Our business number is area code 866-1867. If somebody offers you something from your bank and you want to figure out what's really going on here with that offer, 256-886-1867. Give us a call. We'll help you to figure that out. Let's finish this up. So here's what we need to know, folks. If you make a partial prepayment, there will be no changes in the due date or in the amount of my monthly payment unless the note holder agrees in writing to those changes. Agrees in writing to those changes. What they're trying to do is rewrite your mortgage. When you do that, don't let them do it. Keep doing what you've been doing to save money. All right. So let's talk about saving money now. Okay. Let's talk about saving money. So now somebody asked me before, says, Don, I want to be able to let me stop. Let me remove this. Okay. Says I want to be able to pay on I want to be able to get a $700,000 mortgage. And we're talking about prepayments. Okay. Let's get into that right now. So Ms. Latoya, I hope that's been helpful to you. So we're going to go ahead and change my screen here. All right. So let's jump into, let me get this off my screen. We don't need this anymore. All right. And close this down and move this back. There we go. There we go, ladies and gentlemen. We're back now. We're back. All right. So I'm getting ready now. To put something on the screen. Here is a $700,000 mortgage. All right. And we're going to talk about why we don't want to prepay this thing. Okay. I may put a large down payment on it. All right. So there are mortgages where you can put down 3.5%. There are mortgages you can put down 10%. And some people are actually saving up to put 20% down on the mortgage because that's how they've been taught. Do you know anybody that's trying to save up 20% to put down on a mortgage? So let's talk about that for just a second. Okay. So if I have, let me put this on the screen, 20% down on this mortgage, 700,000, and the interest is at 7.5%. Whoo, 7.5. All right. So let's put that on the screen so we can see that. All right. We're going to change to this. And we're going to put this on the screen. Boom. There we go. All right. 700,000 at 7.5%. If you're new to the room on Clubhouse, go to the chat. You'll see the link to the YouTube channel. Go to the YouTube and you can see what I'm putting on the screen right now. When you see that, all right, then go ahead and subscribe. We're trying to grow our subscribers. So would you please be so kind as to subscribe to the YouTube channel? I'd appreciate it very much. And watch some of the other videos and like and comment. All right. That'll be good. That way we can get the message out. All right. So here's what we're talking about. $700,000. So if I'm going to put my calculator on the screen. Okay. My calculator on the screen. Bring that over. We're going to put it in this box over here. So we got 700,000. Okay. Times 20%. Okay. 20% equals 140,000. That's what they want. They want $140,000 down on this thing. $140,000 down. If you put down 20%. Never, ever, ever do it. Well, Don, if we put down 140,000, well, let's do the math. So we got 700,000 minus, okay, 700,000. Okay, then my mortgage would be 560,000. So let's put that in 560,000. Let's compare that. Now, somebody asked me about this 560,000. Okay. I have 7.5% interest. We're going to take a look at that and we're going to compare. All right. I got too many zeros here. Delete that. My finger got stuck. Okay. There we go. What is going on here? Oh, I did have the right number. I had the right number. I just had the wrong interest rate. 7.5, not 7.5% interest. Take that out. There we go. I'm moving too fast, ladies and gentlemen. All right, so here's what we've got. Now take a look. I need you to take a look at this $700,000. This is how it's sold to you, ladies and gentlemen. And this is why we need to understand how a mortgage actually works so that when we hear the jargon, we will know what to do with it. $700,000. My payment is $4,894.50. Number one, if you can't afford this payment, you have no business being in a $700,000 house at this point. Okay. So let's just assume if I'm getting a $700,000 mortgage, I can well afford it. Okay. Let's just assume that. All right. So I can afford to make this payment for $4,894.50 is my payment. Here's how much interest they want on this thing. Look at this. $1,062,000 in interest. That's just the interest. That's just the interest. I will say it one more time. That's just the interest. Listen, how is $1,062,000? How is that 7.5% of 700,000? Well, it isn't. It's actually 100. Look over here to the right. It's actually 151%, 151.7. That, my friends, is crazy money. Nobody wants to pay that, but we do it all the time. Now, what I'm saying is, even if you have this loan for 360 months, number one, you don't have to pay. You can pay it off in less than 360 months, and you don't have to give them all that interest either. You don't have to. So, but watch this. So what they're going to do is they're going to say, well, if you give us 20% down instead of 3% down, here's what you could do. Here's your new loan, $560,000. Now look at that payment. It's $39.15. All right. And look at the amount of interest. The amount of interest you're going to pay over 30 years is $849,000, which is still way too much. Listen, this is the interest that they want. This is the money that you borrowed, $560,000, and they want you to pay $849,000. That's after you give them upfront $120,000. Wow. Okay, we don't want to give them all of that money. Okay, so if we listen, what is that? What is that again? Okay, 700,000 times 20% is 140,000. Yeah, 140,000. I said 120,000. 140,000. I don't want to give them. I don't have to give them that. But if I do, look at this. They're going to try to make $849,000 look good because they're comparing it to $1,062,000 in interest. But it's still way more than the money you borrowed. Ladies and gentlemen, what do you guys think about that? Okay, still way more than the money you borrowed. So let's not do that. Let's take a look at what we could do. So let's just say we're not going to put 20% down. Okay, we want to put 3.5% down. We're going to put 3.5% down if we can, or even 10%. But we're not going to put 20%. But let's say we could put 3.5% down. Okay. That would mean 3.5% down. Okay. So that would mean 16. That means I have 16. That means I have 16% left that I could use. So we got 700,000 times what is 3.5 from 20 leaves me 16.5, right? Times 16.5%. 16.5%. 0.5% equals, that's $115,000 I don't have to give them. Okay. That saves me $115,500 because I'm going to give them 3.5%, not 20%. So that's $115,000 I still have left. Does that make sense, everybody? Are you following me on this? Okay. So we're going to give them 3.5% down, which means on 700, I got to make some notes here. 115,500. All right. So we're going to do 3% down on 700,000. 700,000 times 3% equals 21,000. So we're going to put down 21,000. Okay. 21,000 is way better than 140,000. Wouldn't you say? But Don, if we do that, what's going to happen? So we got our $700,000 mortgage. And I could have a $560,000 mortgage. Okay. I could have for 30 years and have this payment if I put all $140,000 down. Or I can take my 700,000, okay, and we're going to duplicate the tab, and I'm going to take my 700,000 and put 21,000 down, okay? So minus 700,000, okay? And that's going to give us a mortgage of $679,000. So we're going to put in a new mortgage of $679,000. Okay. $679,000, right? At 7.5. We're going to take that payment out, and there it is. Okay. 679,000. All right. Now, if I put all 20% down, okay, this is what I have. I start out on payment number 1 at $560,000. Okay. Or I can put 3.5% down. Let me move this one over here. I can put 3.5% down, and I can start out on payment number 1 and owe $679,000. And here's my payment. But if I put 3.5% down and I had all 20%, that means I still have $115,000 in my bank account. Is that correct, ladies and gentlemen? Do I still have $115,000? What could I do if I was determined to put all 20% down? Could I now take the $115,500 I have left? Could I put that with my first payment on this loan, on the $679,000 loan? Let me show you something. I'm going to go down here because see, here's cumulative principal. Here's cumulative interest. Okay. 600 and no. Okay. Wait a second. I got too many zeros in here. 679,000. I'm going to take that out. Boom. There we go. $679,000. Okay. So I got cumulative principal and cumulative interest here on this loan. So if I take a look at cumulative principal, that's all the principal payments added up. So I'm going to, if I wanted to put the rest of that money on there, let me take my $115,000 instead of making a down payment with it. Why don't I make a prepayment with it? Remember what we read about prepayments earlier? When I give them that prepayment money, can they charge me interest when I give them the $115,000? Can they charge me interest on that money? Put a yes or a no in the chat. Yes or no. Can they charge me interest on a prepayment? What did we read before? All right. I'm looking for my answers for all of our students here. All right. If I give them that money, can they charge me interest? All right. Oh, BJ says no, they can't charge you. They can't charge me because I'm giving it to them, and I'm giving it to them in a time which makes it impossible for them to charge me. Watch this. cumulative principal, we're going to go down to $115,500. Oh my gosh, 115,000. How close can I come to 115,500? It's right about in here. Right about in here. 115,500. This is 115,900. Okay. 115,900. Folks, 144 payments. That's 12 years. Are you saying instead of giving the bank $140,000 up front, instead of giving them $140,000 up front, okay, and having, listen, if I give it to them as a down payment, I have a loan of $560,000 and I start out on payment number 1. Or I can give them 3.5% down and then give them $115,000 on the first payment. And look, I still have a $560,000 loan. Look at this. Still 560, but I'm knocked 12 years off of a 300. Remember, you have a 360 month loan. Okay. But I just knocked off 144 of those payments in just 1 month. But I have a payment the next month. Okay. If I give them this, here's my payment the next month. What I would normally pay, the 144th payment, that's 12 years worth of payments. I've just eliminated by not making a down payment, by not making a down payment, but I've made a prepayment instead. Listen, ladies and gentlemen, if this makes sense to you, put a fire emoji in the chat. Put a fire emoji in the chat right now and say, I'm never, ever going to make a large down payment on a loan when I could take that money and prepay it. And in this case, knock off nearly 12 years off this loan. 144 payments. And I need you to look at this. I need you to take a look at this. I need you to take a look at this, Brooklyn. And everybody else is putting fire emojis in here. Look at this. By doing this, look how much interest I've just eliminated from this loan in 1 month. In 1 month, over $563,000 I will never have to pay in interest. Oh my goodness. Oh my goodness. Look at that. $563,000 you don't have to pay, and you just knocked off 144 payments you don't have to make, and you still get the $560 mortgage you wanted in the first place. Lord have mercy. Why are we encouraged to make large down payments when we could take the money and do so much more with it? When you amortize a loan, ladies and gentlemen, when you amortize a loan, that's what it does to you. We don't have to make all 360 payments. You can give the bank money in a way which makes it impossible for them to charge you interest. And what we learned, ladies and gentlemen, is by giving them the money I was going to give them. Listen, it's a matter of a few seconds. All right. Now, before you sign the mortgage, listen to this now. Before you sign the mortgage, you could put $140,000 down. Before you sign the mortgage, you could put $140,000 down. Okay. In just a few seconds, or say, I want to put 3.5% down. Okay. And then you sign the mortgage. Now you're in the contract. And then a few seconds later, you can give them the rest of the money, which goes straight to principal, and knock off 12 years off your loan in just a few seconds. A few seconds before, it doesn't do much for you at all. A few seconds after, knocks off 12 years off the loan and saves over $500,000 in interest in just a few seconds time. Why isn't this being taught in schools? You tell me. Why isn't this being taught in schools? What do you think? Can I get some people to come up to the stage and start asking some questions? Listen, of the people that are on the stage, do you invite to speak? Come on, ladies and gentlemen. Come on up. What do you have to say about this, Miss BJ?
Well, first of all, as an educator, working in the school system, I can tell you it. The school system is not designed to help you do anything other than go back to the industrial age when they built houses around the industry, and taught you and your kids through schools to get an education. Now, let me tell you what they meant when they said that. What they meant was that you would be knowledgeable enough to work for the industry, and know how to at least add, subtract, multiply, and divide, so that when you're doing piecework, which I did as an 18-year-old, I used to have to do 1,000 pieces of thing for General Electric. That was my first job, real job. And I learned from that we were designed for the industrial age to work for corporations. They did not design education for you to become wealthy, which is why if you look at most wealthy people, including your Bill Gates, at some point they drop out of formal education because they begin to realize formal education was never designed for them to become wealthy, self-made millionaires or just millionaires, period. It is only designed for you to work for the corporation.
Wow.
And that's what those degrees do. And that way and let me tell you something else, because I used to do HR, because I built 3 behavioral health clinics.
Come on now. Keep talking. What happened to you, BJ? Come on. Don't disappear on us now. It was sounding so good. Oh man, we lost her. We lost her. Listen, when you get a chance, BJ, come on back, because I heard you moving around. Your signal's probably a little low. All right. But anyway, folks, she's right. She is right. This education, the financial education that we receive, does not prepare us for what we are looking at right now. It does not prepare us for understanding how the banks make their money. I need you to listen. I need you to focus in on this right now. There are those in this country and all over the world. They have a lot of money. They don't make anything. They don't produce anything. They don't manufacture anything. All they have is money, and they want to rent it to you so that they can make more money. So what we do is that you and me, in the grand scheme of things, we are a natural resource, like gold in the earth, like diamonds in the earth. Okay. Like copper or silver or tin, a natural resource that needs to be mined. So what is the resource? We go out, we get a job, and our focus is, how do we get into the middle class? How do we have a nice house? How do we drive a nice car? How do we get our kids in a good school? Okay. Those are what things that we look at. But those who are in charge saying, listen, for you to get that house, you need to borrow the money. For you to pay for your education, you're going to borrow the money. For you to get the car, you need to borrow the money. You're going to borrow that money from me, and you're going to pay me this kind of interest on that money. Let me show you what I mean by this. So, because even on the very first payment on this loan, okay, $503.92 goes to principal. Look how much goes to interest. $4,243.75. And they set this thing up so that I can pay them 360 times each month. Look, this is what I'm buying. I'm buying my house back at $500 a month. But look what I have to give them. They set this thing up so they can charge me 360 times. But they don't know that you came to watch the P.I.L.L. method on the P.I.L.L. method channel, And you just found out that if I take that money that I had saved up to put down as a down payment, if I use it as a prepayment, I can knock off 10 or 12 years off the mortgage right now and save hundreds of thousands of dollars in interest. I don't have to pay you. Why? Because you put the rules in the loan. I'm just following the rules. That's all we're doing. We're just following the rules. The rules say I can give you money, and any prepayment I give you, you can't charge me. What? But because I didn't learn in school what that really meant, yeah, I'm just going to, I didn't know how much interest I could save by doing that. You know, I'm looking at the $200,000 in interest I could save over 30 years if I give you $140,000 as a down payment, not if I give you 3.5% down. I'm not looking at the $560,000 I could save in just 1 month. 563,000. Look at that. Isn't that crazy? $563,000. I never, and listen, if I don't do anything else, I could, if I just make every payment from then on for the, we just took off 12 years. So that's 36 minus 10. Okay. So now I got 26, 20, 24, 24 years left. Okay. I'm sorry, 20. What am I talking about? Got 360 payments. Okay. I got 30 years. All right. And I just took off 12. All right. So I got 20, I got 18 years left. Okay. 18 years left. What in the world is going on here? What in the world is going on here? I can just make payments for the next 18 years. I can, with my down payment money, and I transfer it from down payment to prepayment, I instantly change a 30-year loan into 18 years. Somebody says over here on YouTube, my mind is blown. Okay, look at that. Okay. They said, my mind is blown. All right. Look at that. Okay. So what happens with the mortgage insurance? Oh, Lord have mercy. Look at that. What happens with the mortgage insurance? This is what it does. Okay. If you put down enough money in the beginning, you can avoid mortgage insurance. If you put down enough money in the beginning, all right, you can avoid mortgage insurance. If you want to do it this way and say, I don't want to put all that money down. If you have the type of mortgage, where they're looking at, as soon as you get it down to 80%, you can apply to have your mortgage insurance taken off if you have that type of mortgage. So what would happen if you start out, because you're not putting enough down to avoid PMI, all right, private mortgage insurance, you're not putting enough down to avoid it, but you have to start out paying it. So in the first month, you're paying PMI, correct? What happens if you take that money and now put it down as a prepayment? Now you get it down to your 80%. So can you apply to have your PMI taken off? So what is it? You may pay, because you start out paying PMI, doing it this way, you pay 1 month of PMI, you put down your $115,000, boom, you save $560,000, you knock off 12 years, and then you pay PMI 1 month, but you get to do all these other things with that money. And you only have 18 years left on the loan. Man, oh man. What have we been, listen, what have we been talking about? What have we've been sold a bill of goods to put the money down up front. You know what happens when you put the money down up front, right? You put the money down up front. The bank takes that money and lends it out again. I said, okay, well, we get to lend that out. They still get to lend the money out if you give it to them after the loan, though. If you give it to them after you close on the loan, they still get to lend it out. But guess what? It didn't save you $560,000 if you give it to them before. Miss BJ, are you back?
Yes, I'm back.
Come
Yes,
on.
I'm back.
Now you were telling us some stuff here about education, and we're educated to become employees. Did you have anything to finish up on that?
Yes. Not on that, I work for the bank. And if you've never read your disclosures when you were opening your bank account, what you don't know is the reason why they want you to, pay their mortgage off in 30 years and all this other stuff. Not only do they loan that money out, but at as soon as the bank closed, that's why they make them hurry up and settle. That money goes into the Forex and crypto market to generate more money for the bank. They have to have the money back in your account at 5 a.m. every morning. So they actually settle, take your money out, loan some of it out, and then put some in the financial markets to play the markets. And so this is why they don't want you to know what you're teaching ice, and they'll never ask you to come into a university and teach mathematics. If you tell the people that, read Robert Kiyosaki's book, he talks about it. And in fact, he had a video where he talked about it. He said he went to his father, who was a PhD and an educator, and he said, Dad, why don't they teach us how to be wealthy in school? He said, dude, the government doesn't pay us to teach you to be wealthy. They pay us to teach you to be workers, employees. That's why if you look at the educational system, you'll see why your children are learning things that really don't even relate to real life. Do they ever teach them how to reconcile a bank account? No, there's certain things they're not going to teach them that. And I used to do that in my 6th grade class with them. I used to make them do projects, right? But I'm not going to get into all that right now. But the point is let's get this in our head and get it right. You are taught to be an employee, to create more and more debt that's bad debt. Because like what ICE is teaching us, you can make money with good debt, but you got to understand what is good debt, what is bad debt, how it works to make you wealthy as opposed to broke as an employee working from paycheck to paycheck to paycheck. And I teach that in my wealth class. So yeah, you're teaching them right. And I understood your principle because I was doing it on a smaller level. And I didn't get the part about where you were explaining today, taking that down payment though and prepaying. But I did understand the prepayment part of it. So thank you for enlightening me, because now you brought me to a bigger picture in my mind. Now I can help people more, except the ones that I need to send to you so you can walk them through, because I'm not going to take on your job. But at least I now can understand why I'm sending them to you so that they can get out. However, remember something. If you did this on a massive level, they'll come looking for you. It's like that Illuminati, them 13 rich families at the top that control the markets, they'll come looking for you.
Watch out now. Don't put me out there. Don't put me out there.
Yeah, exactly. That's what I'm saying. So I'm not gonna put you. Hey, look, I'm not gonna put you out there so they won't come, because they don't intend for people to be wealthy. They can't afford for you to be up there at the top. Just think about it. If everyone went from being broke to being wealthy, then the wealthy wouldn't really have the status they have, because everybody would be wealthy. They're not gonna allow that.
It's all about that status, isn't it?
Absolutely.
And listen,
absolutely.
You being wealthy doesn't take a dime away from them. It doesn't. But it does. Listen, nobody at the country club, okay, wants to eat dinner with the waitress that can now afford to eat at the country club. Okay. So what good is being at the country club if the waitress can afford to eat here? Okay. That's what we're talking about, ladies and gentlemen. So I need you all to watch this now. I need you all to take a look at this, what she was just talking about. I'm putting something on the screen here. Let's put it up. Okay. It's called mortgage-backed securities. Mortgage-backed securities. She's saying they're taking your mortgage, and they're still doing this. They're packaging them up, and they're selling them mortgages on the open market. And that's what these mortgages are all about. In fact, doing this the wrong way is what caused the markets to collapse around the world in 2008. These mortgage-backed securities right here, and they're still doing it. They're taking your mortgage and they're lumping them all together and saying, listen, you buy this and then you can make this money. All right. So here's what we're talking about. The bank itself, your mortgage company itself, does not make money on this interest. If you have a your mortgage is with Chase, or your mortgage is with Wells Fargo. Wells Fargo isn't getting $4,243.75 worth of interest. Wells Fargo sold that mortgage as soon as they got it. They got paid a premium for that's how they make their money. You borrow $700,000 from them. They put this thing out there to be sold on the open market. They got their $700,000 back plus from an investor. Okay, so we got people who invest in these things, and the investor is getting this $4,000 a month. In fact, they're getting the whole thing. Okay, they're getting the whole thing. And here's what's great about being an investor in mortgage-backed securities. I buy the loan from the bank. I get $4,243.75 a month just from this one mortgage. Just from this one mortgage, I get that every single month for 360 months. Okay, for 360. Okay.
You're telling the truth.
So now here's what happens. Because I pay because some of that money is taken off my loan. Some of that money is taken off my loan. The $503.92 goes back to it's just paperwork. All right. My indebtedness is reduced by $503.92 in that first month. But this next month, the investor still gets $4,243.75. I need you to think about this right now, and I need you to think about it hard. Listen to me when I'm saying what I'm saying here. The $500 that goes to pay down your loan is not subtracted from the $4,243.75 that the investor received. They get all $4,243.75. And on the paperwork, your loan is reduced by $503.92. And then the next month, your loan is reduced by $507.07. And then the next month, your loan is reduced by $510.24. But the investor every single month gets all $4,243.75. It's a great deal for them because the amortization schedule says, now you can only charge me this amount, $4,243.75, no more than 360 times. On the 360th payment, that's 30 years from now, you have to stop charging me. But I'm telling you, on the very last payment, okay, the first payment, these two numbers add up to $4,243.75. The very last payment, 30 years from now, if you keep the loan for 30 years, if you add this up, the amount that went to principal and this tiny amount that went to interest, okay, it still adds up to giving that banker $4,243.75. This thing is like gold to them. Now, the only thing that you can do is keep them from charging you 360 times. It's the only thing you can do. So, how about owning an asset worth $700,000, but you're able to pay it off in 7 or 8 years? Somewhere between 7 and 10 years. Okay. So if you had it for 10 years, okay, 10 years, That's 120 payments instead of 360 payments. Now, for that investor, even if you pay it off in 10 years, they have 120 payments that you gave them. All right. And your payment is $4,700, $4,747.67. Okay. For 10 years, you gave them that money. That's 120 payments of $4,000. That's still a heck of a lot of money. It's just not 360 payments. So people who are in this industry, what are they afraid of? Are you ready? You want to see what they're afraid of? Boy, here we go. Let me put it up. Mortgage-backed securities. I'm going to add something to that. Okay. Mortgage-backed securities, managing prepayments. I need to show you. Okay. Managing prepayments. Do you see this? The risk of mortgage-backed securities. And one of the things that in this mortgage-backed securities, listen to that. Look at this. A mortgage-backed security, all right, they are afraid of prepayments. Okay. Wallet registers the impact of principal paydowns over the lifetime of the security. That's what they're afraid of. Okay. That's the only thing they're afraid of when it comes to these mortgage-backed securities. Let me go back here to just all right, I need you to see this. All right, mortgage-backed securities, prepayment strategies, all right, analysis and investing. Look at that. Managing the risk of faster payments in amortized mortgage-backed securities. Look at all these articles that are on. I need you to look it up yourself. Look up mortgage-backed securities and then look at all the articles and the math that they go through just to try to figure out how much money I'm going to lose if I get this mortgage-backed security with all these mortgages in it. How much money am I going to lose if they prepay? So let me ask you this, ladies and gentlemen. This whole thing, this whole economy, this mortgage-backed securities make the whole thing run. These things are like gold to them because most of you will pay your mortgage on time. Most of you will pay your mortgage on time. And they know if I get this mortgage-backed security, I'm going to make money on this. This is a no-brainer. This is a no-lose situation. And the people who will not pay are a small percentage of all the loans that I have in my securities. The people who will not pay and the people who will prepay are a very small percentage of all the ones that are in here. Most of you will pay your mortgage on time. And they're going to get that money, and it's not reduced by the fact that more of your money that you're paying goes to principal to offset the amount of money that you owe in the loan, but it does nothing. It does nothing to reduce. Come on, let me go back here. This $4,747.67. It does nothing to reduce it on the investor side. They get all of this money every single month. But when it comes to looking at your loan, oh, well, if you're paid down to here, that means that's 12 fewer times they get to charge you. But this $539.67 was not subtracted from what you owe. I mean, from what they receive. The investor gets all of it. This is just paperwork to reduce how much you actually owe and how many times they can actually charge you. That's what this means. So Ty, what's going on, girl? I says, hi, Don. It says, I somehow can't find your room on Clubhouse, so I'm asking my question here. Go right ahead, sister. So if you go on Clubhouse, just search for ICE or search for P.I.L.L method. It should come up. I don't know why you. Yeah, you've been off Clubhouse for a while, but anyway, she's got a question here. It says, my friend is actually going through this right now. The problem is she can't qualify for the loan without a larger down payment. Well, that's okay. So here's what she's putting in. All right. My friend is actually going through this right now. The problem is she can't qualify for the loan without a larger down payment. That's okay. What I'm saying is, let me qualify my statement. Only put down as much as you need to get into the loan. How about that? Only put down as much as you need to. Now, if you put down as much as you need to get into the loan, that's okay. But some people want to go beyond that and put more than what is required. Your friend has an amount that's required to get this particular house. Well, do what's required, but don't do more than what's required. Does that make sense, Tay? Listen, you need to come in. You need to find us here on Clubhouse. You need to go to Clubhouse and search for P.I.L.L method. Use that search function to search for my name, search for ICE, search for P.I.L.L method. You should be able to find it because I need you to come in here and help me out this morning. I got my nieces in here. She's on her way to work. All right. But ladies and gentlemen, she wanted to talk about we've talked about qualifying for a loan. We've talked about prepayments. We've talked about today, if you're a first-time home buyer, how to get into this thing. All right. Listen. I am unique. I am unique has something to say here. All right. We're gonna put this on the screen. It says, I pay between $300 to $600 more in principal per month. Okay, unique. Here's what I need you to do. Okay, I need you to understand this part. When you put down the $300 to $600 down, you are saving time and you are saving interest. But I need everybody to listen to me now. How much time and how much interest is being saved each time you do that? That's so important. It's not just enough to give them the money. You need to know, have a strategy in how much interest that's actually saving you. Because if you put the right amount down in the right month, you see, the people that are on my program, they don't put extra money on the mortgage every month. Only, I don't know, every 3 to 4 months on average. Every 3 to 4 months, we're putting money on the mortgage and we're still getting out of debt in about 7 years. So get with me and we can talk about it. Go to ice10k.com and then I can show you how you can use your money that you're making right now to save even more interest, because now you're tracking the interest savings. You know exactly how much interest you're saving per dollar every time you put money on principal. And you need to know that in order to come up with a great strategy. You need to know what you're receiving for your money, because some of you are putting too much on at the wrong time. Some of you are not putting, you're putting too little on. And some of you are just flat out doing it at the wrong time. What if you knew, what if there was a way for you to have a GPS right on your computer, on your phone, or on your tablet, a financial GPS that says, move this much money in this month, on this day of the month, and put exactly that amount on this particular loan. And then it tells you how much interest you just saved by doing that. And you can know with confidence that's the most money and interest you could save per dollar, because you didn't put on any more than you needed to. Because any more actually works against you. It's called the law of diminishing return. You can't put too much on at the wrong time, because your whole goal is not to pay the loan off faster. Listen to this now. Write it down if you haven't written it down before. Your whole goal is not to pay your mortgage off fast. Your whole goal is to pay your mortgage off cheaper. The best loan, the very best loan you can get from a mortgage company is one where you pay zero interest at all, ever. That's the best loan. And you're not going to get that. The second best loan is this one. The loan where you pay the bank the least amount of interest that's mathematically possible for you. That's the second best loan. And the only way you can do that is make sure that your payments are optimized. You're paying the right amount in the right month on the right day of the month so that you can get the biggest bang for your buck. All right. Now, I'm telling you, I'm going to get gas. I'm going to get gas when I leave here. When I leave the office today, after this show, I'm going to get gas because I'm below a quarter tank. I've already looked at Gas Buddy. I've got my favorite gas stations around, which I know that they're the cheapest gas stations in town. And on the way home, I'm going to say, okay, which one of these that I'm going to stop at on the way home? Folks, there's just a few pennies difference between the most expensive gas station and the least expensive gas station, just a few pennies. But guess what? I just went through an exercise to save me about $1 on a fill up. I'm only going to save less than $1 on a fill up. What we're talking about here, ladies and gentlemen, is saving tens and hundreds of thousands of dollars by borrowing money at a discount. I'm going to be talking more about this on Sunday. Okay. I'm going to be in a different room. I'm going to be in the mortgage syndicate on Sunday at 8:30 a.m. Central, 9:30 a.m. Eastern. And we're going to be talking about how much money is actually being saved on these loans when you can. Well, listen, I want to thank everybody for being here. All right. So we've been here long enough. I want you to go to ice10k.com, ice10k.com. Let me change my look here. Okay. Let me see here. We're going to get this off the screen. All right. We're going to go back to this look and get this off the screen. All right, there we are. All right, so what we're doing now, ladies and gentlemen, I need you to do this. Go to ice10k.com, all right, and get a savings and earnings report. All of this information our clients receive, because not only do they receive technology that guides them like financial GPS, but all of our clients get this kind of education along the way. Okay? So we can stop making these mistakes, the mistakes that we are taught to make, and they're told to us that these are the best practices to save money. But these best practices, I guarantee you, are making money for the bank. We're going to show you how not to do that. We're going to show you how to play the game by the rules so that you pay the least amount of interest that's mathematically possible. You know, why not? Why not do that? So let me go ahead and put this on the screen. All right, let me see here. We're going to put ice10k.com, ice10k. Ice. There we go. Ice10k.com. We're going to put that back on the screen. There we go. All right, ice10k.com. And then you're going to click on, we're going to scroll down a little bit and click on Get a Savings and Earnings Report. When you fill this out, it's free, ladies and gentlemen. It's free. You can get your savings and earnings report for free. You can know the month, day, and year you're debt free and how much interest you could save. And then we're going to show you, by taking that amount of interest that you save, if, let's say, you can be done, you have a new 30-year mortgage, you could be done in 7 years. That means that's 23 years without a mortgage. What if you could took that money and invested that money for the next 23 years? What would that make for you? We're going to give you that once you fill this out. All right. Not only how much interest you can save, but the month, day, and year you could be debt free. And it's usually within a 7 to 9 year window. That's the average. All right. So that's number one. Number two, if you've learned anything today, not only do you want to get a savings and earnings report, I need your help. If you've learned something today, I need your help. I want to get this information out to everybody. And I need your help in getting eyes on the YouTube channel, because these videos stay up all the time. You don't have to teach this. Just get people to watch the videos on YouTube. Can you do that? Well, I don't want you just to do it for free. I want you to sign up to become an affiliate. Sign up to become an affiliate. Go to my ICE 10K card, ice10k.com, and become an affiliate. Become an affiliate of the P.I.L.L method. You fill this out: name, phone number, email address, and how you want to get paid. That's it. It is that simple. It's free. You can sign up to get paid. So by sharing this information with people so that they can watch it on YouTube, and you follow up with them, say, listen, are you still interested? Yeah, I'm still interested. Okay. Then what you do is you go back to the same card, scroll down, and click on refer a friend, and put your person's information in here: their name, their phone number, their email, their zip code, and your name and phone number in as the person who referred them, and any other additional information you think we might need, and then submit that. Once they become a client, we will pay you $300. If they have at least $100,000 in debt and they become a client, we will pay you $300. People are filling that out already. People are filling it out already. Okay, I see it's coming. I'm getting requests already to become a P.I.L.L method affiliate. Okay, and then when you follow up with them, just ask them, "Are you still interested in this information?" They said, "Yes." Well, let me fill this out for you, and then the crew over at P.I.L.L Method International will give you a call. They will get you to fill out the amortization schedule, get you to fill out a savings and earnings report request. All right. And then once you fill that out, we're going to call that person. Once they fill it out, we're going to call them and verify all the information that's in there. Once it's verified, then they will know the month, day, and year they're debt free. Let's say they can get out of debt in 7.2 years. Do you think they'll want more information on how to implement that plan? Yeah, that's how they become a client. They get to know everything up front before becoming a client. And they have a program that is a lifetime program. Listen, we have one new client. One new client who's been a client for 2 months. 2 months. By following our program, they've already saved about $9,000. No, I'm sorry, $19,000 in interest already. Okay, $19,000 in interest already in the first 2 months. Folks, it's a lifetime program. And the amount of interest that they've already saved more than paid for their program, than they paid for it. But they have the program for the rest of their life, not only for this mortgage, but for the next one, and the next one, and the next one. They never have to pay another dime to us. They have access to the program. They'll have access to customer service and access to coaching the whole time. Listen to this. You can't beat it with a stick. The education. Oh, speaking of education, we cannot forget this. All right. We're going to go back. You see this button down here? Buy my book. Get the book today. It's going to give you the basis of a good foundation. If you want to teach this to your kids or your grandkids or your nieces and nephews, getting the book and helping them to understand this from this level is going to be crucial. Get the book. It is the only book on Amazon out of 33 million titles that even begins to talk about this subject. Use the book along with the videos. Oh my goodness, you can become an interest cancellation expert as well. And in the new year, we're going to start having, listen to this, we're going to start having boot camps and trainings on how to become an interest cancellation expert. You'll be able to explain this like I do. And you could get on the lecture circuit. You can start teaching this, and people will pay you for this information. You can become a coach. Listen, people need to know this. I can't, one of the reasons why we're doing this, all these videos is, I would like to live forever, but I'm not going to. But this information will live forever. Somebody's going to take this information and take it to the next level. Will it be you? Will it be you? Will it be you? Who's it going to be? Who's going to take up the mantle and take this information and take it to the next level so that everybody can know what they should have been learning while they were in 8th grade, 7th grade? Okay? Everybody needs to know this. So get the book, become an affiliate, and get a savings and earnings report. All right, let me see if I've got any more questions. All right. So how come they ask? Oh, so Carrie wants to know. So how come they ask for 20%? Okay. Well, listen, it's the 20% down, Carrie. The 20% down is kind of a standard in the industry, because the banks want you to have some skin in the game. They think if you put 20% down, it's less likely that you'll default on the loan, because you've worked so hard to put all that money into it. Okay, but 20% isn't required for residential in most cases. The most it's going to be is 10%, and you can get it down as low as 3.5%. But Carrie, that's why they ask for 20%. It's just so that you can have skin in the game. All right. So, folks, get your savings and earnings report. Fill that out. Okay. Now it's already Friday. If you fill it out and get it done today, guess what? Chances are you're not going to get a phone call today. Okay. It's not going to happen. Give us till Monday or Tuesday, though, and we'll call you back, confirm the information, and get you out your savings and earnings report. We don't work on the weekends, all right? And especially tomorrow, because tomorrow I'm at church. So for all of you that it applies to, happy Sabbath to all of you, because that's exactly where I'm going to be tomorrow. I'm going to be in church tomorrow. But once we get back on Monday and Tuesday, we'll be able to give you a call and follow up on all the requests for savings and earnings report when we come back. All right. I'm looking for other comments or questions. I'm not seeing any. Let me go to YouTube. Let me go back to the internet. I'm not seeing anything extra here. Ladies and gentlemen, I want to thank you. Come back on Sunday. Start telling people about this. Become an affiliate. Start sharing this with other people. And I'm going to get with our team. And on the first of the week, we're going to be sending out emails to all the affiliates. All the affiliates will get an email, and we're going to do a training. Okay? We're going to be doing a training. And we want you to sign up for the training. If you are, the training is $24.95. If you've never come to a training before, it's $24.95. $24.95. Okay. $24.95. Somebody just raised their hand. Let me see who that was. Did somebody raise their hand to come to the stage? All right. I'm not seeing it. Do it again, because I missed it. Raise your hand to come to the stage. All right. I missed it. I'm sorry, because I don't see it anymore. But anyway, what was I talking about? Shoot. Anyway. Okay. Be back here on Sunday, and we'll go over more information on how much money is actually being charged and how much money can actually be saved on this thing. It's not a little bit of money. It's huge amounts of money. you can borrow money at a discount. We're going to dig way deep into how to borrow money at a discount. How? That's going to be that's going to be the title of it. How to borrow money at a discount. Okay, that's going to be the title of the show for Sunday. All right, so we're going to get out of here. I think I've got covered everything. We're going to hear from Dr. Eric Thomas in just a minute. You know, E.T., the hip hop preacher, he used the P.I.L.L method strategies to pay off his mortgage cheaper and faster. And it made his wife feel so much better when he did. All right, so we're going to go over and we're going to play that in just a second. But I want to thank everybody for being here. So let me get this off All right, come back to here and we're going to take this off the screen. All right, so don't forget, folks. I was talking about becoming an affiliate. That's what I was talking about. Become an affiliate, and then we're going to do an affiliate training. It's $24.95 if you've never come to a training before. If you've been to one before, you don't have to pay to come to this next one. All right. So come and get trained on how to make between $300 and $3,000 a month as a P.I.L.L method affiliate. Between $300 and $3,000 a month as a P.I.L.L method affiliate. And you don't have to sell anything. All you have to do is what I said. Get people to watch the videos, follow up with them, and then send in the referral card. We take it from there. And when they become a client, we pay you between $300 and $3,000 a month. So if that's interesting to you, let's be there. So let's get ready to hear from Dr. Eric Thomas. I'm going to get out of here. Thank you so much for being here today, everybody. And be back here on Sunday so that we can continue the conversation. Oh, in the meantime, come up with some ideas about what you'd like to see on the show. All right, please do that. Join and subscribe to our YouTube channel and get people to watch it. But listen, if you want to get paid as well, sign up to become an affiliate. All right. So let's hear from Dr. Eric Thomas, and we'll see you guys on Sunday. All right, Eric, what do you got for us?
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.